Let's move on to downside reversals. So this is on page 60. When I talk about downside reversal days, I'm talking about individual stocks. And if you've been to chart school or attend the level 3 next month, I'm going to talk about downside reversals in the context of individual stocks. And what I'm going to say is that a downside reversal doesn't necessarily mean your stock has peaked, but it typically does portend further weakness in the short term at least. So if we see the same kind of action in the market, we want to be prepared for it and adjust our exposure accordingly. So we're going to define a downside reversal as a day in which the index hits a new 13-week high. It's going to close in the bottom 25% of the range. It has to close down for the day. So it actually has to go into new high ground and then close down for the day. There's no volume requirement. Now, oftentimes we'll see heavy volume on a downside reversal, but it's not necessary. And we're going to require there to be a certain spread from the high to low of that day of a minimum of 1.75%. This is another change that we've made over the past year from earlier iterations. Basically, the point of a downside reversal is the index made some progress into new high ground. It's at brand new highs. And then it gave up everything and closed way down for the day. Or maybe it's just down a little bit, but well off its high. It's giving you the feeling like you made progress and you gave it all back by the end of the day. If you have a tiny spread where you're up a little bit into new high ground and you close at the bottom of the day, but it barely looks like anything budged, that's not really giving you the feeling like you made a lot of progress and you gave it all back. So that spread requirement of 1.75 is going to be our minimum requirement for a downside reversal. Let's go over some examples here. Here you're in the midst of a decent rally here. You're rallying up nicely. You go into new 13-week high ground here, and by the end of the day you reverse the entire amount. You close down for the day. You're in the bottom 25% of the range. So that's a downside reversal. And you can see that it led to about another week or so of weakness before it recovered. On page 62, let's go over some more examples. Here we're rallying up nicely, and you get a downside reversal. Again, new 13-week highs, closed down for the day at the bottom of the range. Now in this instance, it only led to one more day of weakness, so it wasn't that helpful in this case, but you never know. In this instance up here, it actually occurred at the peak. So you hit your peak of the rally here. You barely go into new high ground, but still a large spread here. So it kind of can happen in two ways. It can happen whereas you make a lot of progress and close down a little bit, but still near the close of the previous day. Or in this case, you went up a little bit and then you really collapsed. I've seen them both ways. Here's your downside reversal, and you can see this was the very first sell indicator in a long slide in the market. Let's move to page 63 and look at a few more. You're in the midst of a nice rally here. You get a downside reversal, and it doesn't lead to much. This leads to a few days of weakness here. Here's another downside reversal. Again, leads to a pause for about a week. Up here you have another downside reversal, and it led to really just one really bad day, a kind of a shakeout day. It went down to the 21-day and came back up. The presumption is that when you get your downside reversal, it's going to lead to further weakness. Okay, that's typically what happens. If nothing else, at least a little pause for a few days. But if the index reverses and goes right back up into new high ground within 2 days, we're going to admit that it was a bad, faulty indicator, and we're going to reverse our decision to sell. We're going to have a buy signal. So that's what we call a downside reversal buyback. One of the corrective measures is correcting a mistake we made. We had a sell indicator on the downside reversal, but it didn't work. The index goes right back up into new highs within 2 days. So we're going to kind of correct it and buy back. Let's take a look at what that looks like here. Right. So the question was, why are we requiring it to go into new high ground in such a short period of time? Downside reversal will typically lead to further weakness. A normal pullback might be 4, 5, 6 days. Maybe it's the top of the market. It just keeps going down. But within a very short period of time, like the next day or the day after, you're at new highs, Obviously, the downside reversal didn't lead to any weakness. So we're going to say, you know what, it didn't work. The downside reversal didn't lead to a pause. It just was a faulty indicator. I sold, maybe I raised a little cash, and the market kept going up. So we were going to say, listen, if it happens in a very short period of time, within 2 days, we're going to admit it didn't work. If it happened a week later, in a way it did work. When we studied this downside reversal buyback, turns out if you look at all the downside reversals in the history of the NASDAQ over 42 years, only 18% of the time do you get a buyback. So 82% of the time, the market does not come back within 2 days. So you could say over 80% of the time, in a way, it kind of works. At least the market doesn't just come right back. But 18% of the time, the market's so strong it continues to come back, so we're going to correct it. Here's what it looks like. Here's your downside reversal. You're at new highs, close at the bottom of the range, down for the day. 2 days later, you go right back up. So it didn't lead to any weakness. It was faulty. So we're going to buy right back. So that's your B9, your downside reversal buyback. So a few days later, we have another downside reversal. That's a classic downside reversal. Go way into new high ground and give it all back, close at the bottom of the day. And you were down the next day, and it didn't really lead to a lot more weakness, but it didn't come right back either. So we're not going to have a downside reversal buyback based on that one. Okay, let's move to page 65 and go over a few more of these.
Isn't that a lot like Churn? I know it's not Churn, but it felt like Churn. S11, the first one. Then you have a reversal buyback. Then you have another reversal day.
This is a kind of a choppy period in the market. It's a confusing time. Normally, if I saw this action, I would be concerned. You're down, you're up, you have another downside reversal. You could say, when you have a lot of downside reversals, typically if you're doing stock analysis, that is kind of churning action, particularly if it's happening within a short range and it's not really making a lot of progress. So yeah, I would say that in this area here, you hit a new high, you come down, you hit a new high, you fall again. This is kind of churning in the market. I would agree with that. All right, on page 65, here's a downside reversal. You're at a 13-week high. It's off the chart, so it's hard to tell, but this is a downside reversal. It leads to about a week of further weakness in the market. Here's a downside reversal, followed the next day with a buyback. So it didn't lead to anything. Didn't work. Here's another one. Same thing happened. You reverse right back up. Keep in mind, this is the end of this chart is April of 2000. So this is the last 4 or 5 months of the tech bubble. So you are in a crazy bull market at that point. And it turns out that many of the buybacks occurred within this year. Like a big majority of them actually just occurred in the 6-month time frame. So again, you were in a very strong market, and the market was so resilient it just kept coming back. So here are a few other ones. Here's a downside reversal. This is kind of what we would expect to happen. You get a downside reversal at new highs, and then further weakness for about a week or so. You get some more buy signals in here, and your market recovers. Another downside reversal, another buyback, and here's some more in here. Downside reversal. This one we did not have a buyback because within 2 days you were still not above the high. But in this case, you had it here, and 2 days later you were at new highs. Here's 2 downside reversals. This one's a buyback, and that is your peak. That's the highest point the NASDAQ ever was. It still hasn't gotten to that point. 15 years later, that was the peak.